Welcome back, everyone. Let's begin by acknowledging a powerful question that has lingered in the minds of many individuals who have held certain currencies for years or even decades. What if the long-awaited shift, often discussed in hopeful and speculative terms, actually began to unfold in a manner that defied common expectation? The very idea that fragmented pieces of groundwork observed over time could coalesce into a more significant financial event is the core reason phrases like shock revaluation or overnight RV circulate with such intensity within certain communities. This conversation is inherently charged with anticipation, and it is crucial to navigate it with a clear-eyed focus on mechanics and verifiable facts, separating observable processes from layers of passionate speculation. Today, we are going to walk through these concepts, methodically, examining what is plausible, what falls into the realm of speculation, the necessary systems that would need to be functional, and what observers might realistically watch for as potential indicators. The distinction between confirmed actions by official institutions and unverified claims circulating online will be carefully maintained throughout this discussion. It is important to state unequivocally that this is a commentary on processes and reports, not a guide for financial action. The goal is to translate technical and often opaque financial concepts into accessible language, providing a framework for staying informed through a lens of neutrality and factual observation. We must start by establishing a foundational reality that governs all discussions of currency value adjustments. Official entities, namely central banks and government financial ministries, are the authorities that set and change formal exchange rates. These institutions frequently issue public statements aimed at maintaining market stability, which often include denying or downplaying speculative rumors about imminent revaluations. For instance, recent and explicit comments from the Central Bank of Iraq have stated there is no current intention to alter the official exchange rate, categorizing revaluation talk as market-disrupting speculation. Such denials are a critical data point, revealing the official narrative these institutions wish to project and their immediate goal of managing public expectation. Simultaneously, it is recognized that central banks engage in ongoing operational activities that are not always highlighted in public announcements. These can include adjusting currency issuance volumes, revising internal protocols for foreign exchange, or updating contingency plans for various economic scenarios. This creates a perceived dichotomy between public pronouncements and private technical preparations, a space that naturally fuels intense analysis and discussion within holder communities. The practical takeaway is that official denials should be treated as a significant part of the informational landscape, while operational indicators from reliable sources provide another layer of data regarding systemic readiness and potential policy trajectories. To have a meaningful conversation, we must first define terms with precision. A revaluation, in a strict policy sense, refers to an official adjustment of a currency's exchange rate against other currencies. This is a deliberate act of policy, which could involve changing a fixed peg or altering the parameters of a managed float. A separate concept, redenomination, involves changing the face value of banknotes, for instance, removing zeros from the currency, which is primarily a logistical exercise to simplify transactions without necessarily altering the currency's external purchasing power. When discussions mention a dramatic multiplier such as 1,000 times, they are typically describing an hypothetical scenario of sudden, immense increase in purchasing power relative to major foreign currencies like the US dollar. An event of such scale would not be a simple or casual decision. It would necessitate a comprehensive suite of coordinated actions, legislative changes to empower the central bank, complete operational readiness within the banking sector, formal agreements with international financial partners and correspondent banks, and the arrangement of substantial liquidity buffers to support markets during the transition. These are monumental technical and logistical undertakings, not steps that can be executed in secret or without extensive visible preparation. Understanding the sheer scale and complexity of these mechanics is the first and most important tool for distinguishing between technically feasible scenarios and purely speculative fantasy. One area where observable data can be found is in the management of physical currency supply. Central banks routinely control the amount of paper money in circulation for various policy reasons, such as controlling inflation or preparing for the introduction of new note series. Data published by monetary authorities can show measurable declines in the currency issued during specific periods, which some analysts interpret as a deliberate tightening of physical supply in anticipation of broader systemic changes. It is vital to note that such actions have multiple potential motivations. Reducing currency in circulation does not equate to a definitive signal of an imminent revaluation. However, these operational moves are tangible and measurable changes in how a central bank manages its monetary instruments. For observers, they represent real activity versus mere rhetoric. The ability to interpret such supply-side indicators, understanding whether a change is symbolic, a routine technical adjustment, or a substantive preparatory step, is a key skill for anyone monitoring this space seriously. It shifts the focus from what is being said to what is actually being done within the financial system's operational framework. Another essential distinction lies between official and market exchange rates. In many economies, the rate published by the central bank for official transactions differs from the rate available on the informal market or in everyday street-level trading. This gap often exists due to capital controls, limited access to foreign currency through formal channels, or imbalances between supply and demand. The Central Bank of Iraq, for example, publishes a daily official selling price for US dollars that licensed financial institutions must adhere to, which can be distinct from parallel market rates. When dramatic claims about value jumps arise, it is critical to identify which rate is being referenced. A shift in the informal market rate does not constitute an official revaluation, though it can reflect underlying economic pressures. To maintain an accurate picture, any rumor or claim should be compared directly to the official technical bulletins released by the central bank for its regulated institutions. Furthermore, confusion often arises from the misuse of financial slang in community discussions, leading to the rapid spread of misinformation. Grounding one's understanding in primary source documents from the relevant monetary authority is the most reliable way to filter signal from noise. A common question concerns the practical steps a government would take to prepare for a large-scale currency reform, whether a revaluation or redenomination. The answer is multifaceted and largely unglamorous, involving extensive technical and legal work. Preparations typically include amending central bank and currency laws, overhauling internal systems within the central bank and commercial banks, rigorously testing and upgrading national payment and settlement systems, designing and printing new banknotes if a physical swap is planned, securing foreign currency reserve lines or swap agreements with partner central banks, and coordinating with international financial institutions for guidance and support. Documents from entities like the International Monetary Fund detail these processes, as they have assisted numerous countries through similar transitions. The overarching goal is to ensure stability. A chaotic transition would be devastating for everyday commerce and banking stability. Therefore, methodical, measured preparation is the standard operating procedure. For those watching for signals, the most credible indicators include published legal amendments, central bank bulletins detailing new operational procedures for banks, changes in how liquidity is reported or managed, and evidence of coordinated system testing across financial institutions. These are the building blocks of a managed change. We cannot discuss this topic without acknowledging the profound, emotional investment many holders have in these currencies. For individuals, these holdings often represent years of patience, intertwined with personal hopes and financial planning. When communities discuss scenarios like an overnight thousand-fold increase, it frequently serves as an emotional shorthand for a transformative life event. This emotional energy, while understandable, can amplify rumors, causing minor operational updates to be interpreted as guarantees of a massive outcome. The human tendency toward confirmation bias is powerful in such environments. This emotional landscape underscores the importance of translating that energy into disciplined, patient observation. While community enthusiasm drives conversation and can surface interesting leads, it should never replace evidence-based evaluation in one's personal financial decision-making. The value of a careful, analytical approach is that it provides a stable framework for monitoring developments without being swept away by cycles of hype and disappointment. Protecting one's financial well-being requires a commitment to verification over viral claims. Considering realistic timelines is another necessary exercise. If a government embarks on a path toward a significant revaluation or redenomination, the process from decision to implementation is typically measured in months or years, not hours or days. Even accelerated announcements are almost always predicated on substantial preparatory work that has already been completed behind the scenes, legal frameworks enacted, liquidity lines established, technology validated, and contingency plans drafted. The speed of any financial market recalibration is constrained by the operational plumbing, the ability of banking systems to clear transactions, comply with cross-border regulations, and manage sudden surges in volume. Therefore, when encountering talk of a sudden, smooth, and enormous change in value, a key question to ask is whether the visible operational infrastructure needed to support such an event is already in place and proven. In the absence of clear, multi-layered preparation, such promises remain in the realm of specula. regardless of how compelling the narrative may be. The logistical realities of global finance impose strict limits on the pace of change. It is also crucial to differentiate between the economic stories of the currencies often discussed together, namely the Iraqi Dinar and the Vietnamese Dong. The dinar situation is deeply tied to Iraq's oil-dependent economy, specific domestic political developments, and the country's management of U.S. dollar revenues. The Dong's context is shaped by Vietnam's export-oriented manufacturing sector, foreign direct investment flows, and its management of global dollar liquidity pressures. While both are subjects of long-standing speculative interest, their underlying drivers and policy levers are distinct. For observers, this means that a rumor or policy development relevant to one currency cannot be directly applied to the other. Evaluating the plausibility of any significant move requires understanding the specific economic mechanics, pressures, and policy tools unique to each nation. For example, a change in rules governing dollar repatriation for Iraqi banks has different implications than a shift in Vietnam's capital controls on foreign investment. A one-size-fits-all analysis is inherently flawed and can lead to misguided conclusions. Examining the interplay between public and private signals offers a concrete example of how to interpret developments. Publicly, central banks almost universally communicate a message of stability, denying plans for abrupt change to prevent market panic. Operationally, however, they may be quietly testing new digital systems, adjusting liquidity provisions to banks, or altering the pace of printing and withdrawing banknotes. When holders see a strong public denial alongside a technical report showing a contraction in currency issuance, it creates a layered picture. Public messaging aims to maintain calm while technical adjustments build capacity for future policy options. This is why dedicated observers monitor both official statements and hard operational data such as currency issuance statistics, new internal guidance memos to commercial banks, and changes in reporting requirements for exchange houses. These operational facts are legitimate points of interest that indicate activity within the financial system, though they do not, by themselves, guarantee a specific policy outcome like a revaluation. They are pieces of a much larger puzzle. In environments charged with anticipation, scammers and opportunists find fertile ground. It is critical to be wary of offers that promise guaranteed windfalls, exclusive insider access to exchange windows, or services that require upfront fees to register or process future exchanges. Fraudulent schemes often mimic the language of official processes, using terms like bank contacts, official appointments, or limited-time rates to appear legitimate. A consistent rule is that any request for money up front in exchange for access to a future revaluation event should be treated as a major red flag. Always verify any offer against independent public sources, official central bank websites, statements from licensed commercial banks, and reputable international financial news outlets. Never share private banking details or send funds to unverified individuals or entities based on promises of special access. The safest course is to assume that any legitimate currency exchange process will be publicly announced and administered through official regulated banking channels when and if such an event were to occur. To further clarify the spectrum of possibilities, we can outline a few simplified, realistic scenarios. The first is a path of technical preparation, where central banks and governments undertake system strengthening and legal reforms without any immediate announcement of a rate change. This increases systemic readiness but does not guarantee a revaluation will follow. The second is a managed policy announcement, where authorities declare a specific change with a clear timetable supported by published legal bulletins, coordinated bank instructions, and visible liquidity arrangements. This represents a transparent, executed decision. The third, a chaotic or failed attempt, involves announcing a policy shift without the necessary operational backing, leading to immediate market disruption and hardship. This scenario is rare, as authorities and their international partners strive to avoid it due to the severe economic damage it causes. For holders, the first two scenarios are manageable with careful observation. The third is the cautionary tale that underscores why preparation is typically slow, deliberate, and technical. The presence of thorough preparation is, in fact, a sign that authorities are seeking to avoid a disorderly outcome. For those monitoring developments in real time, a short checklist of concrete verifiable items can be useful. First, official central bank bulletins regarding exchange rates or banking procedures. Second, public statements from the National Finance Ministry or equivalent. Third, changes in the reported volume of currency in circulation. Fourth, newly published operational instructions for commercial banks concerning currency handling or exchange. Fifth, any legal amendments to central bank or currency statutes. Sixth, public statements from major international financial partners or institutions regarding coordination or support. These are measurable signs, not hearsay. When multiple items from this list begin to align, for instance, a legal amendment coincides with new bank operational rules and a statement from an international partner, the probability that a significant policy process is underway increases and merits closer, documented attention. Isolated rumors, in contrast, do not constitute a pattern. The concept of liquidity is paramount in this context. Here, liquidity refers to the capacity of the banking system and foreign exchange markets to facilitate the buying and selling of the currency in large volumes without triggering a collapse in value or a bank run. If a revaluation were announced but there were insufficient foreign currency reserves or swap lines to meet the potential surge in conversion requests, the result would be instability and a loss of confidence. Therefore, a cornerstone of preparation is ensuring liquidity buffers, arranging contingency funding facilities, and establishing clear legal frameworks for collateral. International institutions and major global correspondent banks play a key role in providing the cross-border plumbing for large transactions to settle securely. So, discussions about liquidity preparation are not abstract. They refer to one of the most critical technical prerequisites for any substantial change in currency policy. Without these arrangements, a policy shift could be logistically impossible or dangerously destabilizing. This leads directly to the recurring question of whether a 1,000-fold overnight jump is technically possible. In a purely mathematical sense, if a government decided to change its official peg by such a magnitude and every single prerequisite, legal, operational, logistical, and international, was perfectly aligned, a rapid repricing could occur. However, achieving that level of seamless secret coordination across so many complex domains is extraordinarily difficult in practice. Historically, large exchange rate adjustments, even in times of crisis, often involve staged processes, prior policy shifts, or managed floats that allow markets to gradually absorb the change. The political, economic, and logistical hurdles make a surprise, windfall-style revaluation an outlier scenario for any country with a mature, interconnected financial system. While the arithmetic allows for it, the real-world mechanics of global finance suggest a different, more gradual reality for most managed policy transitions. This is a crucial distinction between theoretical possibility and practical probability. Another practical area to monitor is the issuance of public guidance regarding banknotes themselves. When central banks or treasury departments release detailed instructions on how to exchange, redeem, or verify the validity of existing notes, it often signals that authorities are planning for some form of operational handoff. This could be for a redenomination, a note series replacement, or part of a broader reform. Such instructions do not automatically mean a revaluation is coming, but they do indicate active preparation for a transition in how physical currency is handled. For holders, being able to parse this language, distinguishing between high-level policy, statements, and granular step-by-step operational rules, is a valuable skill. The latter type of communication is a strong indicator that concrete steps are being taken within the financial system, moving from theory toward implementation. External global pressures also form an inescapable context for any national currency policy. Exchange rates do not exist in isolation. Factors like global U.S. dollar strength, international trade balances, geopolitical events, and foreign investor sentiment exert constant influence. A country reliant on commodity exports, for instance, must consider global price swings. A nation deeply integrated into global supply chains is affected by worldwide dollar liquidity conditions. Therefore, any domestic policy decision regarding currency value must be evaluated against this global backdrop. A revaluation that seems sensible from a domestic perspective might be economically unfeasible if it clashes with the realities of foreign reserve levels or international debt obligations. The rationality of any major move is always filtered through the prism of global economic relationships and flows. Community behavior in holder groups presents its own dynamic. These communities are often excellent at crowdsourcing information, surfacing obscure regulatory filings, and maintaining a vigilant watch on official bulletins that mainstream outlets might ignore. This collective scrutiny can sometimes identify genuine early signals. However, the tendency can be to conflate these early signals with guaranteed outcomes or to accept single-source, unverified claims as definitive proof. A balanced approach treats community reports as valuable leads, starting points for independent verification, rather than as conclusive. Evidence. If a community post highlights a new central bank document or a legal filing, the next essential step is to locate and review the original official source before drawing any conclusions. This discipline separates informed observation from mere rumor participation. For someone engaging with this topic regularly, developing a personal system is advisable. This could involve maintaining a short list of trusted primary sources to check routinely, such as central bank websites and major financial news wires. Community forums and social media can be placed in a separate category treated as speculative until corroborated. It is also prudent to manage one's own time horizon and financial planning independently of speculative outcomes. Immediate financial needs should never rely on hypothetical currency events. Regarding physical holdings, if applicable, ensuring notes are stored securely and legally, with proper documentation, is a basic but important step. Constant vigilance against social engineering, attempts to exploit excitement or anxiety to gain personal information or funds, is equally critical. The emotional environment makes individuals potential targets, so a stance of healthy skepticism is a protective measure. We must also touch upon the subsequent implications of any potential currency value change. Should a significant revaluation occur and translate into gains for holders, that event would likely carry tax consequences and legal reporting requirements, which vary greatly by an individual's country of residence. Currency gains are often treated distinctly from other capital gains under tax codes, and the rules can be complex. This is another layer of reality underscoring that a change in exchange rate is not an isolated financial event, but one that triggers a cascade of administrative and legal considerations. For this reason, if a holder ever needs to act on a verified change, consulting with licensed tax and financial professionals before making significant decisions would be an essential step. The downstream implications are as important as the event itself. Returning specifically to the Vietnamese dong, its economic narrative is distinct from Iraq's. Vietnam's economy is driven by manufacturing exports and attracts substantial foreign investment, facing specific pressures from global dollar dynamics and domestic credit growth. While speculative rumors exist, the more relevant observable signals for the dong include levels of foreign exchange reserves, trends in trade surpluses or deficits, regulatory actions to manage credit risk, and government communications about capital flow management. In essence, plausible movements in the dong's value are tied to visible economic policy levers and macroeconomic performance. Treating the dong and dinar as separate cases with different drivers, exposures, and policy tools is necessary for accurate analysis. Conflating them under a single rumor template leads to a misunderstanding of the underlying fundamentals at play. A recurring and vital reminder concerns the risk of fraud. Rumor cycles create perfect opportunities for bad actors to offer fake exchange services or sell appointment slots for future redemption. Any offer that requires an upfront wire transfer, a processing fee, or promises access to a special rate outside of official banking channels should be considered highly suspect. Legitimate banking procedures in any country do not involve unverified intermediaries collecting fees in advance for a future service that has not been officially announced. Protection involves demanding everything in writing, independently verifying the credentials of any entity claiming authority, and cross-referencing all claims with official bank channels. When in doubt, the safest assumption is that it is not a legitimate offer. Preserving capital and personal information is far more important than acting on a potentially fraudulent opportunity. As we consider what constitutes credible evidence of increasing probability for a policy shift, a step-by-step framework is useful. First, the enactment of formal legal changes that grant explicit authority to alter the exchange rate regime. Second, the issuance of central bank operational bulletins that provide licensed banks with specific logistical instructions for handling exchanges. Third, visible coordination such as joint statements or agreements with major international correspondent banks or financial institutions. Fourth, demonstrable arrangements for liquidity, which might be inferred from changes in reserve management or publicized swap lines. Fifth, a staged public communication campaign from authorities to prepare the domestic population and international markets for a transition. When several of these substantive elements converge, the narrative shifts from speculative rumor to an observable policy process underway. Until such a convergence is evident, excitement should be tempered and scrutiny focused on gathering verified evidence. In closing, the value of steady, critical thinking cannot be overstated. The pattern in speculative environments is that speculation begets more speculation, and attention can solidify into a compelling but unverified narrative. It is possible to engage with a community of observers without being captured by its hype cycles. Maintaining a personal checklist, committing to verifying primary documents, and treating community reports as leads for investigation, rather than confirmation, are the hallmarks of a disciplined approach. Real preparation by governments and central banks is typically technical, detailed, and often perceived as bureaucratic or dull. Dramatic headlines promising instant wealth without a corresponding paper trail of operational and legal steps should be met with skepticism. the journey for many long-term observers is one of endurance and strategic patience. Meaningful policy shifts are complex projects with numerous moving parts, rarely culminating in sudden, costless windfalls. Acknowledging credible progress when it is demonstrably present, while maintaining a realistic perspective on the complexities involved, allows for informed observation without emotional whiplash. The key is to watch the systems and their operational outputs, not just the headlines.